Okay, great. So that's a lot of great information that you're going to share with us. So why don't we just start with discussing the best type of markets for automated trading strategies?
Yes, so let's start with shorter time frames, such as 1 minute, 5 minute, up to 30-minute bars. And positions here are entered and exited during the particular trading session and not held overnight or not held over the sessions. And then here comes the question: what is the most important thing to consider in order for the strategies to be able to trade? What is most important with day trading strategy is that we need some volatility range. We need to cover our risk per trade. We need to cover our commissions and fees. We need to cover our slippage. So we need to have some kind of distance for the day. And markets such as stock index futures or energy markets are the most suitable candidates here. Also, as far as costs go, the cost per trade divided by the volatility. So we basically express the cost of trading in Sharpe ratio, which we'll discuss later and show how to calculate a Sharpe ratio. And this, cost per volatility needs to be low.
Yep. So the main point there is that you need to have sufficient volatility range. So perhaps can you explain what the volatility range means?
Yes, volatility range, usually how traders know it is basically distance, high minus low. This is the basic concept here. And then also there are different kind of markets, and some markets are creating gaps. So in this case, we talk about true range, not just range, but true range here when we calculate gaps, account for gaps. And that is when previous bars closes outside today's range, then this close is used in calculation instead of today's high minus low. And also, not just daily range, but also we can express volatility with the indicator. It's called average true range. When we take some look back period, let's say 20 days, and calculate the average of this true range, these true ranges, and we get average true range indicator. So this is basically one concept for volatility. And also in investment practice, we usually deal with percentages. That means we deal with annual returns or daily returns. And in this case, we use standard deviation, which is, basically we use squared distances from the average of these changes, and then we get variation. And when we calculate square root of this variation, we get standard deviation. So these are two basic concepts of volatility. Each has, its own application. And, this volatility is really the real function that we have to figure out, because otherwise, if we don't have this volatility, we can get this expected return wrong, because many traders expect that they can, make 100% with a, doesn't matter how much the market moves on a daily basis, but that's not true. You have to really take into account the volatility and then calculate, let's say, Sharpe ratio. And in the long run, in practice, we can find out that you're not going to really have much more than 2 your Sharpe ratio. So basically, we can figure out expected return based on this volatility. If we know that we cannot get really much higher Sharpe ratio than 2 in the long run.
Yeah. Now, if I can just jump back to a point you made about true range and the gap. So if we're looking to trade day trading strategies and close the position at the end of the trading session, then why do we need to include the gap in the volatility calculation?
Right.
When it's not something that we can actually trade?
Yeah, because there are some markets that tend to gap overnight. There might be cases where this gap can be covered. So we might get some really small bars and with the gap, but still we need to take the whole picture into account, because the market can go back and create a large bar and cover the gap. So this is really more important range than just small high minus low for the particular day.
Yeah. Okay. All right. So you've explained to us the volatility range. Now, can you give us some examples of markets and explain that in a more practical context?
Yes. It really depends which markets we are trading, because ATRs or these average ranges are different for each market. So it's good to really express ATR for each particular market, and we can see in practice that energies and indexes are really the leading markets that can be utilized for intraday trading, because they've got higher ATR points and higher ATR values.
Yeah.
And other markets, such as let's say grains, recently when they plunged in prices, we can really find very large ranges there, and it's very hard to make any money when we use a Russian level of leverage. So let's say in today's markets we get 6 to 8 points for corn market, which represents about $300 to $400. So we don't have much space, much distance to realize profit in trade session. So when we look at the more suitable market, these are energies and indices such as heating oil, crude oil. Used to be E-mini Russell before it changed the point value, but still it has a nice ATR range there. And of course markets like E-mini Nasdaq, E-mini S&P, also some other markets such as VIX futures is a very interesting one. Or there can be some type of grains can be traded intraday. They've got some nice range, such as soybeans, for instance. Yeah, so for this intraday trading, we really need some range expressed in ATR in points and dollar value.
Yeah, okay. So that table is a really good demonstration of the difference in potential between the higher ATR values and the low ones, like the corn and the 10-year note. Are there any dangers outside of that reduction in potential? Are there any dangers with low volatility markets?
Yes, of course there are, especially when this low volatility is not historical normal, and we got some, let's say, governmental restrictions involved. So, for instance, as it's shown on the slide, we can see example of Swiss franc versus euro currency pair, and there was a really tight range since 2011 till 2015. And of course, many convergent strategies were selling high, buying low, could take advantage when it was returning to the average. But there was a day D, of course, because the volatility was really, really low, and it was January 15th when we got some over 3 standard deviation move. Actually, much more than that. And of course, if you are wrong on the wrong side of the market, you might really be in a big trouble there. So if we got some artificially low volatility state of the market, I would just advise to stay away from that kind of market, because the situation might change very swiftly there.
Yeah, that particular incident with the Swissy was quite disastrous for a lot of people. So
of course, yes.
There's a good lesson there for everybody.
Yeah, if you were not diversified, so many CTAs were trading actually, but these CTAs, they are running diversified trend following programs, so it was not such a big loss when you calculate other positions too. But if somebody is trading intraday and trading just one market or two markets, and of course it's on the wrong side of the market, then it's a really big trouble there. Because and we have seen that with many forex brokers, of course, that went almost bankrupt, had to be bailed out by some hedge funds and stuff like that. So you need to be really careful with such low volatility markets when you have to apply a large, very large leverage to take advantage of the move.
Yeah, and that chart's also a little bit misleading because it's not showing the huge gaps in price as well. So
Yes, it's fluctuation, and it's OTC market there, and when there is no requirement to quote the prices, and the dealers stood away, and you might not be even able to be stopped out. You just you had to get out when the market was able to trade, and it was at the bottom.
Yeah, that's right. Okay, so what about other types of automated trading strategies then? So we've done day trading. Now, what about other styles?
Yeah, other styles. There are two more styles, and these are swing trading. They are holding positions over the sessions, but not very for a long time. They're trying to take advantage of the swings in the market. So these are holding positions for, let's say, a few days maybe, but there are really nice strategies that can be applied for swing trading. And recently, actually, since 2008 till today, swing trading really shows the best performance as far as I have seen. And the markets applied are usually, in many cases, these are the markets that are mean reverting in its nature, such as stock indexes, volatility, some commodities such as lean hogs, or some metals, for example, or currencies that can be used for that. And then this the last approach is this old known trend following, and we are holding position there from days till months, or maybe over a year sometimes. And the advantage of this is that we can apply many different markets. We are not really restricted by the volatility on a daily basis, so diversification there can be large. But they've got some periods when markets are not trending, and it's really hard to take advantage of the divergence in the market. So it really depends what period we are in, and then particular strategy can be applied. But it's really tough to find out which period will be the best at that time. So it's advisable that we combine together several different approaches, intraday swing and trend following together.